Hi, everybody. Chris Englebert with the Englebert Angle for this week, produced by QDeck. Thanks again, guys, for doing this. You can see by my slide deck, I'm going to be talking about reasons why the stock market is sold off, which obviously means reasons why the stock market has gone down the first 6 months of this year. It's been one of the brutalest sell-offs we had since 1970. And I want to go through step by step what everything happened and why it happened. And I want to come out the other side by giving you some arguments as to why we think the rest of the year is going to be a better investment environment, especially for equities in the United States. So obviously we walked in the door back in January, and a lot of people don't really remember history that much. And so that's why I'm replaying this for you. But right off the bat, we had the tanks rolling into Ukraine. Ukraine was at war with Russia, and that conflict caused a quick almost 7-8% sell-off in the market. You then had the persistent rise in interest rates from January through April, with the 10-year bond yield going up literally 150 basis points or 1.5% in a very short time, due to the fact that the CPI, Consumer Price Index, was showing that inflation was running very hot, high single digits, 8-9%. So everybody was worried about, how are stocks going to do in a high inflationary environment, rather than, really analyze that inflation many times helps stock investors. Investors just sold off stocks. Then the other thing you had was the fear of recession. The first quarter GDP, gross domestic product, came in negative, and everybody's like, oh, we're going into a recession. Now, as I do this video, the second quarter GDP has just come out, and that's also been negative, minus 0.9. But you've got to remember, one of the things about gross domestic product, GDP, prints is that they get revised every month for up to a year after they first print. So there's no question the first quarter was negative. The second quarter, though, was driven to be negative by a large reduction in inventories. And if any of you have been watching the news, you've been seeing that Walmart, Target, many of the retailers last year just kept ordering because of supply chain issues, and built up a lot of inventory. And guess what? They didn't need a lot of inventory in the second quarter. So that's why you got that negative GDP print in the second quarter. I'm going to talk about at the end of the video on why we don't think we're in a recession. But the other point that I want to make is that if you follow the cryptocurrencies, Bitcoin or Ethereum, there was a large crypto hedge fund, several $1 billion, that literally blew up, and two more smaller crypto exchanges became insolvent because they had loaned money to this crypto hedge fund. So as Bitcoin sold off sharply in the second quarter, you had this hedge fund blow up. And one of the reasons why we believe stocks sold off sharply in June is that everybody was looking around and saying, is there another hedge fund that's going to blow up? And if a hedge fund is exposed to Bitcoin, do they hold any stocks? And if they do hold those stocks, do they have to sell them down? And we saw some of the Bitcoin related stocks, and this is not a recommendation to buy or sell, like Coinbase, COIN, sharply lower because of obviously what was happening in the crypto world. So what does this all mean going forward? We obviously had a low on June 17th, 3636 on the S&P 500, but you can see by my chart that we've had a rather sharp rally here in July. And we believe that there are some reasons going forward that the investment environment is going to be better in the second half of the year. One of those reasons is supply chain disruptions. The supply chain is healing right now, whereas before it was taking 6 to 9 months for companies to get products that they could make widgets out of, et cetera. Now we're seeing supply chain issues resolved rather quickly. I would not be surprised to see this chart by Goldman Sachs be in the green in another 30 to 60 days, as you see supply chain disruptions virtually come to a halt. Again, we'd like to thank Goldman Sachs for providing several of these charts. They produce some very good work, and we like to use it. The other thing that we think that's happening out there is the big worry about inflation is beginning to ease. The reason being is many of the food inputs, corn, wheat, and soybean, prices are rolling over big time. And then we have the all-knowing and all-fearing price of gasoline. It's been literally down 13 consecutive weeks. Many places are beginning to see an under $4 price on gasoline. And if you follow the gasoline futures, they've retracted some more in the last couple of weeks, along with the price of oil. So many of these inflation inputs, food, fuel, and also lodging or home prices are beginning to come down to help alleviate those fears as far as a recession goes. Now, one of the things that people don't really talk about is you hear on the news the negative standpoint that, hey, consumers are using more credit cards in order to pay for gasoline and groceries as those prices go up. But this chart by Bank of America shows that individuals are still sitting on high cash balances in checking and savings account. They are still hunkered down even 2 years after COVID. So if we saw this chart sloping down, meaning that consumers are burning through their cash much more rapidly, we'd be more concerned. But people have a lot of cash, and corporations still have a lot of cash on their balance sheets, and municipalities have a lot of cash on their balance sheets as well. Now, one of the other things that we've been talking about over the last couple of months is everybody's in this narrative that we're going into a recession. And what we're trying to tell clients is that the stock market is pricing in a moderate to severe recession. Well, again, thanks to Goldman Sachs, they showed this chart here. And over on the right-hand side, you can see the bars showing the drawdown in the stock market or the average decline in the stock market during recessionary periods. And to be quite frank, we've reached that in June. And I think that's one of the reasons why we've rebounded in July, is that people are pricing in a moderate to severe recession. And if we don't have a moderate to severe recession, stocks could be as undervalued by as much as 15 to 20%. So the point of this is people are saying, well, gee, if we're going into a recession, maybe we should sell out of our stock portfolio. And you can see by this chart that literally most of the damage has been done, even if we are going into a moderate recession. So what does this show you? Again, this is a great chart by Goldman Sachs showing that what happens when an economy comes out of recession, what happens to the stock market. And you can see I've underlined a few things. Subsequent returns have been attractive when the first half of the calendar year has been down by 20%, which is exactly what we ended up first half of 2022 being down about 23% for the first 6 months. But one of the things they're trying to show here is that recoveries to the stock market have been relatively quick, anywhere from literally 2 months, which we saw in February and March of 2020's decline, and then we saw a subsequent 6-month recovery to new highs to as long as about 18 months. So the point being is that these relatively quick recoveries highlight the potential cost of exiting equities that have already suffered bear market declines. And one of the things that we were trying to tell clients that June was an ugly month with the S&P being down about 8%, was that we could have a 10 or 15% reflex rally or rebound at any particular time. And that's what July looks like it's going to be. So one of the things that we're trying to show people is the arguments that the world is not coming to an end. And this is a great chart by JP Morgan that during the month of June, a record 12% of companies were trading below cash and short-term investments on their balance sheets, which meant that the stock price was below what the liquidation price of the company was. Obviously, investors saw that there was a lot of value there, and we saw those companies being bid up, and they continue to be bid up. So what does it all mean? Let me wrap it up here. Continue to watch the Consumer Price Index, which is a measure of inflation. We think inflation has peaked, but you may have one more hot inflation number in the month of August. So you're not going to really see the decrease in energy prices and food prices and housing prices till probably the September CPI. The other thing that's been improving is bond market prices or interest rates. Interest rates have actually gradually been coming down from the 10-year peak at 3.5% to currently right around 2.75%. So again, one of the things we do in clients' portfolios is we put bonds for stability and income, and that wasn't working the first half of the year. Well, guess what? The last 4 weeks, we've seen interest rates moderate, bond prices go up, and so bonds are beginning to give you a positive return because people are realizing that there's some good value in the bond market right now. And then our third bullet point is, what if we are not going into a moderate or severe recession that the stock market's pricing in? You could see a potential really good recovery in the back half of the year. Our personal belief is that we're not going to see some kind of recession till the back half of 2023. And in future videos, we can give you reasons why. But for right now, the economy is still healing from the shutdown. we're still seeing good job numbers. Inflation is moderating, and we're seeing lots of signs of capitulation by investors where they're extremely negative, which actually offers a good buying opportunity for longer term investment. So what does that mean for your account performance? Make sure your asset allocation is right. Make sure you're in the right place. As far as the types of equities you want to be in. We've seen recently that obviously over the last year, large cap growth stocks have experienced a lot of volatility. The question is, do you change from that strategy or you do something else? As always, we're here to answer your questions and give you an outlook. We hope we gave you a good outlook as far as what's been going on and the reasons for the recent decline in the stock market and why we think things are going to be better in the back half of 2022. That's all we have for this week. We'll be back next week. We'll talk to you soon.